All right, what is up, everybody? Back at it with another video. So, today we're going to be discussing how to make wealth trading markets and actually keep it. So, you've heard me say this before, but I'll say it again. The greatest edge in discretionary trading is, well, your discretion, but your discretion in the form of knowing when not to use your own system. So, the reality is, we all have to kind of take two steps back and realize that whatever indicator or style system that we're using, any 15-year-old can go read Investopedia and figure out exactly how to use that system. So that would mean that somebody who has a decade of experience is on the same kind of level in terms of ability to read the market as a 15-year-old kid who just read an article and spent all of 15 minutes studying a certain subject. Now, obviously, that's not reality. So, truly, the edge there is the discretion, the experience that you've gained from using that system and knowing when not to apply it. And theoretically, if you know when not to apply your system, you would also know when to apply your system. However, the inverse is not true. If you know when to apply something, you can just simply continue applying it. That doesn't necessarily mean that you know when not to apply it. It just means that you know how to identify those specific triggers, and every time they trigger, you know what sort of action that you need to be taking. The reality is that no indicator is actually profitable. None. RSI, MACD, stochastic RSI, moving averages, it does not matter. There's no way in hell that you're going to be able to apply any arbitrary indicator, slap it on a chart, and magically become profitable tomorrow. That's just not realistic. So the edge truly is in knowing when not to do something. Now, you have to be able to expand your mind a little bit and play onto that concept. If you're using RSI, which I don't, and you're looking for bear divs and you know when those bear divs have triggered, you'll come to realize soon enough that if you were to short every single time a bear div triggers, you're not going to make any money. In fact, you're probably going to have a terrible time. So the edge there would be knowing when to actually listen to that indicator of that bear div triggering. Maybe there's confluence, maybe you have a certain set of rules that have identified why that bearish divergence is different than all the other bearish divergences leading up to that one, and why you should probably try to trade and play into that specific one. Now, obviously, I don't use RSI, I don't use all these different indicators and whatnot. So the only way that I know how to get this idea across is using my system. So let's go ahead and break that down in today's price action on Bitcoin. And I'll actually even give you some examples, both ones that have worked and ones that have not worked. And I'll show you in real time exactly how I'm expanding my thoughts to adapt to whatever price action is doing. Catching extreme trends towards the upside, avoiding extreme drawdown, hopping back into trends once they're being reclaimed, and avoiding choppy periods after realizing that the market environment has shifted. So really quick, here's how I break it down. All right, so generally speaking, the way that I break this down is I have an initial thesis, so that would be plan A, and then whatever that thesis is no longer valid. That would be plan B. That thesis becomes relevant again. So plan A part two. And then plan C triggering is actually plan A part two not working yet again, right? So going from plan A to plan B to plan A back to plan B, at which point, right, we skip this and we say, okay, hold on, wait. We should probably go to plan C and totally reassess how we're doing things. I don't expect you to have caught up with that. So let's go ahead and break it down. First, you need to understand how exactly I go about doing things and what the kind of mindset is as a trend trader for me personally. So do keep in mind that a lot of the examples I'm going to show you have to do with 15-minute 200 moving averages. I'm going to go ahead and front run a lot of your questions. I don't necessarily care about the 15-minute 200s per se, but what I do care about is whatever Bitcoin is respecting, or really whatever asset that I'm looking at is respecting on any given time frame. And that way I can kind of dedicate these labels of low time frame trend portrayal, parabolic trend portrayal, high time frame trend portrayal to those specific time frames, and that allows me to adjust my bias depending on what time frame I'm looking at. The other nuance is I'm going to assume that trends are going to move directionally proportional to the trend prior, which essentially just means if we reclaim a 7-month-long downtrend over the course of negative 70%, I'm probably not just going to look for a 5% push upwards, and vice versa. If we reclaim a negative 3% downtrend over the course of 3 hours, you probably won't hear me start to call for new all-time highs. So that's about it. And those philosophies allow us to apply some sort of context. So if you're in my free Discord, you already know that we caught this move. The way that this this analysis scaled into, it was basically an assumption that we would see this kind of a push upwards. I do daily market updates in that Discord every single morning. So you get to see my thoughts in real time and how I scaled into that kind of a bias to assume that this move was going to come. But of course, the analysis does not matter unless I actually traded it. So here you go. Here's what that analysis looked like in the form of a setup. But all right, now that I got my clout claiming out of the way, let's go back and discuss what the entire purpose of this video is. The context here is the 15-minute 200 moving averages have allowed for an uptrend over the course of, truly it's from this low, but we'll go from where I start to scale into a higher time frame bullish bias. So we'll just say this low. So that means that these 15-minute 200 MAs had portrayed the trend for over a week and have encompassed about 19, or let's just say 20% of price action. So just remember that. Put that as part of your context. 20%, 1 week, one bias. There's no ups and downs. It's just clearly an uptrend. Even a 4-year-old knows that we're headed to the top right corner. So that would mean losing that trend would probably allow for a much deeper pullback, anything that we've seen on that rally upwards for the past week in 20%. And we kind of assume that things are going to move directionally proportional. So even though we're talking about a 15-minute time frame here, that is the low time frame trend portrayal. So that does allow us to assume some sort of significance. And that's what I call a snowball of weakness. If you've seen that why price action is a snowball video, if not, I'll leave a link to that. That does have a lot to do with this kind of philosophy and outlook on the market. So it is kind of imperative that you do understand that concept. But moving forward, so now that our snowball of weakness has formed, we're now in plan B, where we can assume a much deeper drawdown. At that point, that's when I come in and just start marking levels of support and try and pinpoint some sort of higher time frame, maybe swing long setup. Because again, it's not that we're bearish now, it's that this trend is bearish and there is some adjustment necessary, right? The best way to think about it is anybody who's been just simply buying the 15-minute 200 MAs trend this entire way up has done incredibly well for themselves, except for this time they took a loss. In an ideal world where everything is rainbows and butterflies, it doesn't matter because you've already printed enough off of that trend in the first place. Hence, it's just kind of a gradual adjustment to shift your mindset just slightly to go into plan B. So once we're in plan B, there's really two things that we're watching for. We're watching for that snowball to continue compounding towards key support levels. So something like this 29.7K demand zone. We also have hourly 200s, which were confluent with this demand zone at that time. So those are our downside targets. So that's the first thing we're keeping an eye on. Either we get to those regions and then maybe support bounces and access support, but truly as long as we remain below those 15-minute 200 moving averages, we're acknowledging the higher time frame bullish bias, but we're not so eager to hop back into this leg upwards, because in order to resume the snowman of bullish arguments, you would have to crush this snowball first. So at that point, we put ourselves in a position where either the snowball of weakness continues compounding and we can look for our bids wherever they are to potentially continue getting tapped, right? Maybe that snowball continues compounding from here, becomes a bigger snowball, a body of a snowman here, and then so on and so forth. You can continue with that mindset for each and every single dedicated significant trend portrayal. Or perhaps we test that level of support. Whatever you have dedicated is significant. Perhaps we don't. But regardless, reclaiming the exact same thing that has allowed for this profit in the first place would be the next significant step that kind of implies potential uptrend resumption. So that's where we go from plan A to plan B to plan A part 2. So remember, this is a glimpse of weakness. The context here is our higher time frames are also uptrending. So that means we have uptrends across the board on every single time frame except for this 15-minute chart. The reason that we go back to plan A here is because this tiny little glimpse of an argument towards the downside has now been negated, and we've fallen back in line with the context of every single time frame is bullish. This is exactly what the case was on plan A the first time around. We liked plan A. 20% of uptrend, 1 week, one bias, very clear, lots of money made. So when this triggers again, I'm forced to go back into that plan. It's not even really that I'm forced. I'm gladly going back to that plan. All we're doing is going back to plan A. I liked plan A. Plan A made me a lot of money. So I will happily shift the bias once again. But alas, plan A part 2 does not work. So typically, this is where the person goes from plan A to plan B to plan A back to plan B, back to plan A, back to plan B, back to plan A, right? And you continue that process for weeks before you can actually realize that, hey, maybe I need to stop using a trend style analysis because the market itself is not trending. At that point, it's way too late. So instead of go back to plan B for the second time, I take a totally different approach and I kind of just say, you know what? This is all just kind of BS. And I need to stop making the same kind of assumptions that I was previously that rewarded me so greatly, because the reality is that reward was stemmed off of the market environment itself, which has now shifted. So if I continue to apply the same kind of approach in a static manner, meaning I'm just doing the same exact thing each and every time we're above these 15-minute 200s, I'm bullish. Every time we're below them, I'm bearish. I would quickly become the laughing stock on crypto Twitter. And truthfully, that doesn't seem like a lot of fun. More importantly than that, though, your portfolio would absolutely see the side effects of that lackluster approach. And it makes sense. So, I mean, again, put it back into context. We had one bias, we had one outlook on the market, and that outlook was never invalidated. There were never any snowballs of weakness that formed for an entirety of 1 week that encompassed 20% of upside. And suddenly, just within the past 3 days, we've had 3 bias shifts alone. You're finally wrong on plan A, you're wrong on plan B, and you're wrong on plan A again. This all happens within the span of 3 days, with each trend assumption allowing for an additional negative 2% of drawdown, and then reclaim allowing for 2% of upside. So with that, I'm allowed to kind of assume that, hey, maybe whatever I was using previously that worked very, very well is probably not going to work anymore. And I need to take not just one, but 2 steps back and totally reassess how I'm going about approaching this price action. So at that point, that's when I can kind of justify just hiding these entirely and taking on more of a range trader's mindset. This is how we're going to look to approach price action moving forward. And only after we break up or break down below the range am I then allowed to start scaling my bias from a low time frame perspective into a higher time frame outlook. So all that really means is, in the event that we break up and out of the range, that's when I'm allowed to come back and say that the high time frame trend has taken priority and we're probably going to resume the uptrend just as we have for the entire price action that led up into creating this range. And it works for the other side too. So in the event that we lost this range low, I would then be allowed to scale my bias into saying that perhaps now we've locked in more of a macro kind of top rather than just a local top. Because we're talking about low timeframes here for Bitcoin, and part of this video is actually me giving an actionable analysis today, you do have to keep in mind that the higher time frame trend would still be favored bullish anyways. So the reality is that us breaking down below this range would just allow us to look for a deeper pullback. And then the whole process starts all over again from there. We go back into the snowball way of thinking. At this point, we can say that the snowball of weakness has compounded and allowed for additional bearish arguments to be made. At which point we would zoom out and look for higher time frame levels of support to still play into the uptrend on higher time frames. So in an ideal world where everything is rainbows and butterflies and dandelions, BTC would break down below this range and head for this 28.6K demand zone. And by the time that that happened, our 4-hour 200 moving averages would be confluent with that region as support to allow us to justify a higher low on the daily chart with a deeper sense of conviction due to the fact that there's some confluence in that region. So really quickly, I just want to tie in everything that we've learned. So here are a couple real life examples of exactly how I was trading Bitcoin using this kind of a mindset. So as we can see, the 15-minute 200 moving averages allowed for a massive push upwards. Now again, there are some nuances here. The 15-minute 200s were not the reason that I went bullish and traded this trend upwards in the first place, but they eventually became the best way to portray that uptrend. So that's plan A, which means that the breakdown of those 15-minute 200s creates plan B. The reclaim of those 15-minute 200s makes me want to go back to this plan. Remember, we like this plan. We made a lot of money using using that plan. So we will happily go back to it. We use that as a justification for our entry. You hide that stop loss below those moving averages, below the recent market structure, and any sort of key local demand that might go along with them. And you look for uptrend continuation amongst all time frames. All that really means is I implemented Plan A Part 2. Thankfully, the market was nice enough to where Plan C never really became a thing. And now we're going to take the exact same concept and apply it to a higher time frame perspective on Bitcoin not too long ago. And in similar fashion, a reclaim of the 2-hour 200s was not the bullish thesis, but eventually the 2-hour 200s did become the most efficient trend portrayal for Bitcoin. I do kind of want to just state that it's impossible for you to miss this move if you're the person playing into a snowball to snowman kind of way of thinking. The entirety of my system is built around catching extreme trend kind of moves, which lots of people do, but not everybody can have a way of scaling out of that kind of a move. So again, 2-hour 200s, most efficient trend portrayal. That's plan A. Losing that trend, breaking the market structure on something like the 4-hour, or as I said it at the time, the daily, allows us to adapt that approach and take on plan B. And eventually the snowball of strength that gets reclaimed somewhere in this region allows for that snowball to compound into a much bigger argument, at which point, for all of, say, 8 hours, I'm forced to start looking for entries again. Literally 8 hours later, we fully retrace the move, at which point we have gone from one bias over the course of a month that encompassed about 35% of price action to now 1, 2, 3 biases in the course of a week that have encompassed about 10% of price action. At that point, this tweet basically saying, at best, maybe we chop sideways for a week, is definitely me shifting into that plan C kind of a mindset. At which point, I can then go and draw a range, and for the most part, pretty much neglect these 2-hour 200 moving averages and only attribute significance to the much higher time frame upon breaking out of the range in either direction. So then upon losing the range low, I'm then allowed to come back and say that bias that initially shifted somewhere over here around 29K from about a month ago is actually the bias that I should be playing into as of now. To which I was rewarded with further drawdown over the course of the next few weeks or so. So I hope this helps you guys get a little bit of insight to how my brain works when I'm approaching trends. Again, this is probably the most alpha that I'm ever going to possibly be able to drop, because truly the greatest edge in discretionary trading is your discretion in the form of knowing when not to be trading the style that you consider your bread and butter. So if you're not using 200 MA, 200 EMA, you don't see market structure the way that I do, and you don't see support and resistance the way that I do, I want you to take the exact same concepts and apply it to your system and kind of figure out how can you go about knowing when not to apply your system. If you can figure that out, and you have the balls to actually go and press the buttons in accordance with that way of thinking, then I have a high degree of confidence that you're going to do very well for yourself in markets. Last thing before we go, I am giving away a MacBook to anyone who's trading on my Bybit referral link. So any of you watching this right now, if you're already supporting me by trading on my Bybit referral link, that really does help a lot. So I do appreciate you very much. And because of that, Bybit is allowing me to give back to you in some way. So all you have to do is fill out that Google form in the description below, and you'll be automatically entered to potentially win a MacBook. For anyone who's already on Bybit, but you're not under my referral link, you can still submit the form, and that will actually make you eligible for the giveaway and put you underneath my Bybit link. Which, by the way, if you don't have a Bybit account, but you want to make one, again, that is the greatest way to support me. So the link to register a Bybit account is also in the description below. But other than that, thank you so much, guys. Make sure you like, comment, subscribe, and share this with your grandmother. I'm pretty sure she wants to know what the greatest edge in trading is. And to each of you, much love and take it easy.